the most interesting studies I found was that when men take investment risk, men have a surge of testosterone. When I wrote the book, The 7 Frills of Financial Wisdom, A Woman's Guide to Enjoying Wealth and Power, which you can get on Amazon, and I co-authored it with Camilla Webster. He's a wonderful journalist who's now a full-time artist. We interviewed over 60 female financial experts, and we started looking at numbers, and this was back in 2012 when the book came out. And it was unbelievable because we had just gone through the great financial crash of 2008, 2009. Well, HFRI, the hedge fund index creator, came out with some...
Welcome to the Resilient Alpha Podcast, a future-looking session where we explore the evolving landscape of wealth preservation and growth through the lens of resilience and innovation. In today's episode, we're thrilled to host Carol Pepper, the visionary CEO and founder of Pepper International, a trailblazing year-based family office firm established in 2001. She has pioneered the virtual family office model, overseeing more than $5 billion in assets, while earning accolades like Top 50 CEO in Private Wealth and Best Boutique Firm for the Society of Trust and Estate Planners. With over 2 decades of experience in wealth management, impact investment, and family governance, highlighting in her best-selling book, The 7 Pearls of Financial Wisdom, Carol joins us to demystify the world of family offices. We'll dive into the sound investment processes that align family values with enduring strategies, and crucially, how smaller family offices can navigate complex decisions affordably without the need for multi-million-dollar infrastructures, offering actionable insights for building dynastic legacies in an uncertain world. Carol, welcome.
Thank you, Chris.
You've been at the forefront of family offices since founding Pepper International for over 2 decades ago, pioneering the virtual model that democratizes access to high-level advice. Congratulations.
Thank you.
Success. Can you walk us through how the family office landscape has evolved from traditional family office setups to today's hybrid, tech-infused structures, and what signals from current market trend, like the Goldilocks environment you've described in the recent Bloomberg interviews, suggests about the next phase of resilience for ultra high net worth families, or anything else on that front?
Well, it's been quite a journey over the last 24 years. I actually started my business in 2001, in February of 2001. And prior to that, I had the honor to work at the Rockefeller family office. And when I was there were 200 family members, 200 employees, and we had incredible, beautiful offices above Rockefeller Center up on the 30th floor. So it was a very physically heavy, intensive, expensive type of operation. You had a lot of human beings, most of them in the back office doing all the accounting and administration. You had lots of physical locations, and then you had many activities that were still quite manual back in the day, in the late 90s when I started. By the time I left and started Pepper International, the internet sort of came online, and the ability to do online financial services started around the year 2000. So once that happened, I could see that suddenly you're going to be able to create fantastic teams to collaborate globally and pick the best advisors depending on what you are going to be doing. And so I started my business in 2001 for that reason. And over the last 24 years, I've really seen that evolution. Nowadays, families have usually a plethora of outsourced options and some in-sourced options as well. For example, I had an entrepreneur come from Europe and asked me to show him 10 billionaire family offices so he could decide how he should do his setup. Well, at the time, I was able to round up 10 billionaires in New York. And in fact, one guy who had $1 billion had literally one person working for him, and the rest of the operation was outsourced. And another person had over 50 internal employees. So the ability to either have complete virtual services or to have a heavy internal team, say if you're building some sort of investments that you might want to sell to other families, today it's very flexible. And yeah, I've seen many services integrate and then get out into the virtual model. Why? Because it's much more cost effective for one company to assume all the costs, for example, for consolidated reporting cybersecurity, rather than each family assuming those costs on their own. So the virtual model has become much more popular, or quasi-virtual model, because now it's much more cost effective and it's made family offices available to people with as low as $10 or $20 million. So it's been quite a ride and very enjoyable. I really love the way the office has been advancing and evolving over that time.
Well, for someone else who's been around for 25 plus years, I can say that I've also noticed the big change in back office operations and the movement towards outsourcing to people with core competencies in those specific areas. At the core of a resilient family office is a robust investment process. And drawing from your experience overseeing billions in assets, which is impressive, what are the non-negotiable elements of a sound investment framework, such as integrating impact investments with family values or establishing effective investment committees that help families weather volatility without compromising long-term growth?
Well, I think the first thing that's non-negotiable is to have a process and to write it down and to actually follow it. When you set up your own single or virtual family office, you're setting up a mini investment shop of your own. Now, you may be deciding to work with some of the big banks for some of the investments or some of the independent hedge funds, but at the end of the day, you're saying, I want to take the reins. I want to take control of making decisions. So that means you have to actually set up who's going to do what. And by that, I mean, you want to make sure roles and responsibilities are very clear. So to me, family members should always be in charge of their money. Even if they're not very experienced in investing, it is their money. Never let the fox in the henhouse. Never just let the professionals make all of your decisions, because at the end of the day, it's your money, it's not their money. So that's number one. And that means that family members should be out in the investment committee, should be on the board, and should be very informed, which implies that family members have had enough training to be able to read financial statements and to evaluate the professionals who work for them. Now, what does that mean? That means, for example, each investment should have its own customized benchmark. Typically, in the old days and still today, quite frankly, the banks are very sloppy about giving you a lot of information, granular information, to assess how each investment in your portfolio is doing. So if you have, for example, $25 million portfolio that's consisting of a number of different types of funds in an asset allocation, each fund should have its own customized benchmark. And then that fund should be, all the funds together should have a weighted benchmark, weighted to the weight of both your current portfolio and your long-term strategic portfolio. So you can see, how are these people doing relative to the indexes? If they aren't more or less making some money above indexes, then you just revert to buying ETFs, because frankly, they're not adding any value. When you get your statement from one of the big banks, chances are good they'll give you one number for the performance of the portfolio. That really is not granular enough, which leads to the fact that you really need to have independent, consolidated reporting systems. The one that I will always advocate for is ADFR. The reason is ADFR has the best customer service. They really were designed by the Rockefellers, by Justin Rockefeller and some of the people that came out of that shop, for family offices. So every type of customization is available. In addition, when you're delivering reports to the family members, you can make reports complicated for the nerdy, geeky guys who like all the detail, and very simple for people who can only just read a pie chart and understand that they have 3 pies and how big are these 3 pies and are they getting bigger or smaller. So whether you have very unsophisticated family members or whether you have, technical professionals that you have in-house or are advisors to you, you can get the level of detail you need. Also, frankly, you will be shocked to find out how many fees you're being charged that don't show up on the statements, but do show up in the feeds that you get for putting together your consolidated reporting. The next thing that I think is very important is that the family should have an independent chief investment officer type of a function that is not being paid by the products that are being sold to you or the investments. What does that mean? That means you pay a fee to the CIO or the CIO service, and that person doesn't care whether they invest in advisor A or advisor B. Now, I'll pick on JP Morgan, where I used to work. They're always pushing the family, say, you don't need an independent CIO. You can actually just use us. We'll do that for free, and you'll save money. But again, JP Morgan is being compensated in part by the products that are on their platform. So you're putting the fox in the henhouse again. Not a good idea. It's very important to have an independent CIO or some type of independent investment advisory function to help you set up your asset allocation, and tend to help you decide how to use the banks. In my opinion today, the private banks and the money managers are like a supermarket, and these guys have products on their shelves. So you might go in Costco, you might go in Stop and Shop, and you're going to look on their shelves. First of all, you're going to be shocked how many of them have the same products on the shelf. And you might be charged something different, even though it's the exact same product, the exact same fund manager. So note that. But then secondly, you have to be the one in charge of asset allocation independently, because every family has its own goals, has its own reasons for doing things. And I've never seen, in all the years of working with family offices, one family office asset allocation that looks like conservative, moderate, or aggressive that JP Morgan or Goldman or any of the banks show to you. Everybody's asset allocation is often very specific because it depends on what they're doing, what are the operating businesses in, or what are other reasons why they've constructed a particular portfolio. So that is absolutely critical. You stay in charge of asset allocation. That's none of the business for the banks. You tell them what kind of products you want to buy from their supermarket, and then you use an independent, consolidated system to evaluate how are all these money managers doing, especially if you have upwards of 20 million, 40 million, $1 billion. You absolutely need to have independent control over your information. Don't go to Fidelity. I know a lot of people do this, and just take the free custody account and say, oh, I'm saving money. I'm not paying at a par, just using Fidelity. That's a foolish way to save money. Penny wise and pound foolish. You need independent numbers that you control. You need to be able to make the reports understandable for your family members, and you need to have the ability to plug in and remove various advisors or money managers depending on how they perform for you. So the way to make a good family office investment process is to make it independent of any particular financial institution, make it modular, and make sure everybody knows that you have at the top the decision makers, the family members, and the board or the investment committee. In the middle, independent advisors to help with asset allocation and manager selection and monitoring the portfolios. And then at the bottom, the supermarkets, the banks, the lawyers, the tax accountants, all the people that are going to offer products and give you information about them. And I think if you put the family office investment process together this way, you document it in a document and you have everybody read it. And now you have a way to start training your kids about how to make good investment decisions.
Well, I think it touched the fun a lot. And I agree with you completely that an independent CIO inside a family office is important. For instance, if you're dealing with a bunch of different fund managers and you're comparing the funds, you may not realize if you could have a 15% allocation to NVIDIA. There's a lot of overlap along with what you need somebody independently looking over everything to make sure that your diversification is truly diversified.
Exactly right. And you also need a system to be able to look inside the portfolios. And frankly, more and more managers, although they don't like it, are getting access to these reporting systems to look inside the portfolios so that that true allocation can be understood independent of what they're telling their clients.
And just going off the script a little bit here, have you seen any family offices that are veering away from funds and trying to do a little bit more selection on their own?
Absolutely. I think this is the beauty of systems like Addepart. If you have a system like Addepart and you had an independent CIO, frankly, you can put together your own portfolio of equities. In some cases, if you're very carefully managing a lot of tax positions for whatever reason, you can buy those stocks yourself. I mean, what's the difference between having an ETF if you have enough size in terms of the allocation to a particular asset class? You can build your own sort of internal ETF if you like, and you can even measure that performance. So yes, and certainly in terms of private equity, they're definitely less excited about private equity funds, much more excited about finding their own direct investments in private equity. Although, as we know, you have to have enough expertise, either outsourced or, helping you to make sure that you know what you're doing when you're picking those direct investments.
Yep. We won't go down the rabbit hole of AI at this particular moment and the influence it's going to have in this space. But I would venture to say that some family offices are going to gravitate to that because they are probably being laden with fees.
Absolutely. And the problem with AI, though, if you think about it, and those of us who've done financial analysis for many years know darn well, there's a lot of assumptions that you make in inflation rates, in growth rates. People are making all kinds of assumptions. And so if all the AI models are making the same assumptions and pointing to the same trade, what happens to the other side of the trade? This always happens. So yes, it'll be a time saver, but it's a tool. You can't just blindly say, well, the model told me to buy this and I'm going to buy it. Now, there are people, who have a staff of 50 PhDs who have quant models. And even there, I remember one of my clients was invested in the Renaissance Technology Funds with the late Jim Simon years ago. And what would happen? The model, he'd suddenly say, well, the model's not working now and we have to tweak the model. So that was always the excuse. We're going to hear the same thing with AI that we used to hear from the Renaissance people when suddenly the quote-unquote model isn't working and their buy signals aren't working. So there's no difference between black box hedge funds and so-called deep tech and AI. It's all a bunch of models and computers making assumptions. And if they all make the same assumption, woe be unto the person who's on the other side of the trade, or when the model all decided the same kind to sell, then what's going to happen? The bottom is going to drop off from under your trade. So I say, just like you wouldn't give over all the decision making to any big bank, don't give it over to an AI model, for God's sake.
Well, you certainly don't want to be, stuck into a small exit when everybody wants to run. And all of this dovetails into family governance, which often determines whether a fortune becomes a dynasty or dissipates across generations. You've advised on everything from 360-degree family office assessments to legacy planning. How do you recommend families embed governance structures early on to foster alignment, especially when blending diverse family dynamics like those in international or multi-generation families?
Yeah, I've had the pleasure of working with more than half of my families being non-U.S. families over the last 24 years. So I've seen families in Singapore, I've seen families in India, I've seen families in France, I've seen families in Bahamas, in Ecuador, and of course the United States, all over the country. So I've been very privileged to meet a lot of families over the years. And when I start creating a family office for someone who, let's say, has a business and thinks it's time to start creating the family office, we always start from the family values exercise and creating the family constitution. Why do we start there? And then we build the technical family office. Because if we don't know what our values are and we don't know what we want to build and why we want to build it, and by the way, what our kids would like to have and to take over, which today they have very big opinions about what they're going to take over, then it's very hard to build. It's sort of like asking an architect, I want a house. And he says, well, what kind of house do you want? You want modern or traditional? And you're like, well, I don't know, just make me a house. It doesn't work like that. Those two houses are going to look remarkably different. So in the same way, we have to start with values. And so I start literally by getting my families a 350 word list of values and ask them to check off, is this value how you act as an individual, how you act with your family members, how you act to society, or how you act in business? And then I collate the answers from all the family members that answer, which is generally anyone who's in high school or older, frankly, including spouses. And then we see in each of those four categories which values overlap and which values are different. And then we decide which values does our family represent here. And then we create a phrase. So let's say the word is trustworthiness. Could be the phrase is our word is our bond, or it could be we never tell a lie. It will be a different, slight, further definition of what that word means to that family. About courage, or about civic mindedness, or the ability to change, or having an international focus. There's so many different things that could be the values of a family. I'll give you an example. I had one family where the thing they're the most proud of is that they've been around for over 100 years, and every 50 years or so, they've gone into a completely new industry. So as certain industries evolved, they changed. Their entire business changed. I have another family who's very, very proud of the fact for over 400 years, they've been in one place. They've never left that land, and that land is the symbol of their heritage. And they've done oil and gas in the land, they've done ranching, they've done farming, but it's always about keeping the land. So those are very different values, and you're going to build a family constitution and a set of investment principles that are quite different depending on what those values are. So a lot of people roll their eyes and you go, I don't want to do values. That's so hokey. But in fact, every time I've done it, people are extremely happy at the end that they actually have a good articulation of what they stand for as a group and what are they going to tell their kids and their grandkids. Even the young people who are in their 20s, they start thinking about, well, if I have kids or grandkids someday, am I going to be happy with these values? So that's a very satisfied first step. And in a family constitution, which is a written document, you want to make one that's actually usable. I mean, a lot of people hire an expensive consultant and that thing sits on the shelf. And they never look at it again. So, but you can make, when I do a constitution with people, that document becomes something that is living. Every year we review it. And it's about important things like who's going to make certain decisions and how are we making difficult decisions. Some things come up in the first draft. For example, are adopted children considered family members? Are spouses considered family members? Or are family members only people who share our bloodline? And you'd be surprised, even in this modern day and age, how many people say, nope, it's just the bloodline. It's not the spouses, it's not the adopted kids, it's only the people with the same blood in their veins as me. And so whether you agree with it or not, if that's the rule, then what are we doing with the other people who are not bloodline? How are they going to interact with the family? Does this just mean that they're not under the Constitution and the rules that we create? But of course, we still love them, we still live with them, and perhaps we have to have rules about how we provide for the people that are not blood family members, as an example. Does every kid have to sign a prenup if they get married to protect the family from divorce? What happens, does every kid have to have an MBA before he or she comes and works in the family business? Do they have to work somewhere else for a number of years before they come into our companies? Those are rules that you want to make fair, because the reason this evolved, frankly, is because in the old days, it was just whoever dad's apple of dad's eye was, that kid got all the slack, and the other kids hate that brother or sister because they're the favorite, and they live under a different set of rules. And that's what leads to the breakdown of these family offices, lawsuits, and destruction of legacy is resentment stemming from favoritism between mom and dad and the kids. So you get rid of favoritism by creating rules. When you have a rules-based society, you can vote to change the rules, just like having a government, but everybody's under the same rules. So you're not unfairly targeted with a rule compared to your sibling. So that's very important, that everybody live under the same set of rules. That really cuts down on a lot of resentment.
What clear role definition that you're talking about? I mean, we can go back to the ancient texts and find out that the Greeks and Romans were fighting about estates back then as well. So the human nature doesn't change.
Not at all. And in fact, the oldest family constitution that we have, that I know about, that I love, is the Mogi family, who created Kikkoman soy sauce in Japan. They're in their 17th generation still living under their family constitution. Imagine that. So rules they made 17 generations ago are still being adhered to by the family today, which I think is very impressive. So it really does actually work to have rules and to have fair rules that everybody follows. Other things. Okay, dad has onset early dementia but doesn't know it. He's just very irritable, can't remember what he's asking, and he won't admit that he has dementia. Normally go to a doctor. What's the rule? How do we make a rule to handle something like that? Because unfortunately, that's becoming a bigger issue these days. So we make a mandatory retirement age from certain voting decisions. He may scream, he may yell, but it's more likely to get him to sign that than to say, Dad, we think something's wrong with you if we don't want you making decisions anymore. So rules can be your friends in situations like that. Rules also protect kids when it comes to that prenup decision. So, a kid falls in love, wants to marry this girl or this boy, and the other kid is just offended that they're being asked to sign a prenup. What? You don't love me? You don't trust me? You're thinking you're going to divorce me? But if the other child in the family could say, look, it's in my family office. We have a constitution. Every one of my cousins had to do this. It's not against you. That's a lot easier to swallow. And it's also easier to legally defend against in the future. So it helps the family when there's rules. Same things about kids getting pitched a lot of investments from their friends. Or anybody, you're at a party and someone's constantly pitching you, hey, you want to invest in my startup, invest in my AI app, invest in my drone or whatever. You can say, I'm sorry, but in our constitution, it says that all investments have to go through the investment committee. My hands are tied, but here's the address. You can write to them and, we'll find out if you're able to pass or whether it comes before our consideration committee. It's a beautiful and polite way to get out of people harassing you to invest in their projects all day long. And it protects you to make sure that your investment is consistently being protected by people who check everything out for you.
Well, I think, I say to my kids all the time that we live in a world where you have to be incredibly deliberate because everything's either being recorded or you're being listened to somewhere. And in the course of a family that has some wealth, you have to be deliberate in order to avoid future litigation, future problems, and future schisms within the family. This leads to another conversation in terms of the decision to sell the business if the family is in a business. So does the next generation want the business or no? There is a trend towards independent sponsors. A lot of MBA students are coming out. They're seeking to buy these businesses, courtesy of the changes in the corporate landscape and other vocations out there. So talking about family constitutions, which is governing the way that the operation of the family office works. Let's talk a little bit more about how the CIO role plays into that. As we know, in today's landscape, there's a lot of different financial products out there. That Wall Street is changing. The kids are getting pitched different things. How do you see that progress?
Yes, well, it's very important that the CIO function inside a single family office is quite focused on the types of investments that the family wants to make. So remember, we started with values, and then we decided where we were going and, in general terms, the types of investments that we wanted to make. Now we have to find an independent CIO function, whether it's a person or a group, that will help give us that independent advice. And I keep saying that we're independent, meaning the people giving you that advice are only paid to give advice. They are not taking kickbacks from the product. Very, very important. I harp on that a lot because people don't realize that behavior drives compensation. So let's assume that you're going to hire a CIO that matches the type of investor you want to do. Now, obviously, if your CIO is a guy who came from a hedge fund who's only got long-short equities his whole career, but your family has decided they want to go start little small businesses or do roll-ups like you were talking about of HVAC companies or whatever it might be, that guy is not the right person to advise you on that. So you have to make sure that the skills of the family office CIO is going to match the types of projects you want to invest in. That seems intuitive, but a lot of times guys will say, well, I can take care of that too, but they've never had any experience. They might like to learn about it, but it doesn't mean that they can take care of it. Now, what happens when you have a CIO who's been with the family forever, and all of a sudden, out of the blue, we have AI? Nobody has experience in AI who's probably been a CIO for a long period of time. So you trust this person, he or she is very trustworthy, but they're very inexperienced on either deep tech or AI or something that one of your kids really wants to invest in. So in that case, you have to, within your CIO function, create rules. Then say, if this is an area where we don't have internal expertise, we're going to go out and go through a bidding process, just like we would go through to find any outsourced advisor and hire a group to look at that particular investment. Or let's say, believe it or not, there are family offices that have never done real estate. They've done a lot of other things, but they've just never done real estate. And now all of a sudden, I've been working with people that are very strong in medical, and now they want to go into real estate. Okay, what are we going to do? We have to go find a real estate group that's only going to be paid to give us advice, not to sell us real estate project. So you can have a person that you deeply trust. That is really important. That's only paid by you to help you make these decisions, right? That's important. And not too much of his or her compensation should be bonus, frankly, because then they're going to be going to the casino with your money. So you want to pay them a hefty base salary and some upside, obviously. But then they have to be empowered and not feel like they're going to lose their job if they come to you and say, hey, I don't know enough about this area. I need additional help. We've got to go hire a biotech guy for phase 2 drug trials because I don't know how to assess whether this is a good phase 2 drug for us to invest in or not.
So I think that leads back to what we've been saying is, one, communication is key to all the different family members and the staff as well. And that you have to be deliberate in terms of what you want to do to hold true to the values that you identify through your question.
Correct. And you have to be ready to say when you don't know something. And it's fine. As I said, there's one family that built their entire fortune by making total changes into brand new industries over the last 100 years, 4 or 5 times. It's amazing what they did. But how did they do that? They went out and hired independent expertise to help them make those transitions, to choose the right partners. And that's also where having a good network of other family offices that you become friends with and that you help with your expertise to help you pick those experts. So let's say I want to go into real estate and I really don't know anything about it. And I'm in particular, for whatever reason, I want to do real estate in Vietnam because I love Vietnam. I went there on vacation. The place is booming. Well, if I'm smart, I'm going to try to find through my family office networks another family in Vietnam who's really great at real estate and ask them if they could help you out in terms of finding the right advisors, maybe co-investing with them as a way to start while I learn. So that's another area where peer learning from other family offices can be extremely powerful and help you if you decide you want to go into a new area that you're not familiar with.
Well, and I think that leads to probably one of the big issues in families is the desire to sell the business that created the wealth. How do you go about handling that situation when the family, is that part of the original corporate governance document, the constitution that you put together, or is it something that just comes up?
Well, I'll tell you, right now, it is the number one question I'm getting because a lot of people now are in their 50s, 60s, 70s. They had a great run of it. I had one guy in Singapore, for example. He said, look out in the harbor, Carol. I'm like, yeah, it's beautiful. He said, see all those container ships? I'm like, yeah. He said, I scraped the barnacles off of every ship, off the bottom of that ship. And I said, wow, you must be really well-to-do and successful from that business. He said, yes, but my son is a DJ and my daughter is a graphic artist, and they don't want anything to do with my business. So what am I going to do? I've had other people in the real estate business who say to me, I have never sold a building. My father never sold a building. We have all this, embedded capital gain. If we sell, it's going to be a nightmare. But my kids don't want anything to do with this. They really don't want to work. They think I work too hard. They don't want to do it. What am I supposed to do? So there's now a lot of families questioning either the kids have rejected the business, they don't want it overtly, or, Carol, my kids say they want to run my business, but every time I put them in a situation to do a little project, they lose it. They panic, they can't handle pressure, they can't make decisions on their feet. I don't think they can take over my business. I don't think my kids are going to be able to do this. What do I do? So this is the number one question that I'm getting, and I'm telling you, it doesn't matter if I'm in Latin America, Asia, or the United States, I'm getting that question almost every day from somebody. So the first thing is this big fork in the road you're coming out to. Keep the business or sell the business. One guy I know, he's from Colombia. The whole family's in the United States. The kids never go home. It's too dangerous. The answer's clear. If he doesn't sell it, nobody else will be able to. He doesn't have anybody to take it over. He can't trust people who live in another country to really be after the best interests of his kids. The best thing for this man to do is to be, and the brilliant person he is to sell those companies that he has back home, for example. So he's got to do the M&A, and then our next step is, once he has that liquidity, how are we going to reinvest it and create an ongoing liquid family office and figure out how involved can those kids be and how much money should we give them? How much of a living do we give these? But that's another big issue, right? So that's one decision. I have to sell the business. Then you go down the corporate M&A route. You figure out who should buy your business, because trust me, if you're the guy who built the success, you're the guy who should sell the company. No, don't leave that to someone else. No one knows your business better than you do. Get a top investment bank to help you and go out and do an auction, because nowadays, if your business is successful, a lot of people are going to want to buy it. All these private equity shops will want to buy it. The other piece of advice I will give, based on a lot of experience from these entrepreneurs who could sell the whole thing. A lot of the private equity shops try to make you hold back 10 or 20 or 30% and, take it over time. Don't do that, because most times what happens? They hate your staff, even though they're nice to you about your staff while you're selling the business. They fire all the good people. They screw around. Half these private equity idiots are MBAs who've never run a real business. They run it down the toilet, and so you lose a lot of value by waiting. So take all the cash, kiss it on the forehead, and go on your way. That's number one. If you're going to keep it, now the question is, can my kids run it, and can my kids not run it? Or if I'm going to keep it, even though my kids aren't going to run it, who is going to run it? So in other words, you kind of logically have to go through a decision tree process to figure out, as hard as it is, and ideally 10 years in advance if you can. If you're not sick, if you're 50 to 60 right now, I know you feel you're young, you are young, we all are young, but this is the time. Take a 10-year decision. Don't try to make that decision in the last minute when you get a scary diagnosis, which a lot of people unfortunately do. They come to me and suddenly they have to sell it because they've got a year and that's it. So make a decision, hire the experts. And if you're really thinking about giving it to your kids, but you're concerned about whether or not they can handle it, then the younger you can start grooming them. the better off you're going to be. There are people who take their kids to meetings at age 10 and 11, and I always admire those people. Have your kids sit in business meetings with you. I'm sure your dad did that for you back in the day. Apprenticeship. Bring him or her into the company. Bring them on the factory floor. Give them a menial job when they're young. Make them work up the ladder just like anybody else would, so they'll be respected by your employees. Don't just stick them in the corner office and have them feel arrogant and insecure. Both. Very unattractive combination. So those kids today, nowadays, these Gen Zs have anxiety attacks over nothing. If they could never have survived in the 80s and 90s. They're so terrified of everything. And unfortunately, because now they can just Google on the phone anything they want to know about. But in business, you can't Google. Things come up that you have to actually make a decision about. And that's when they lose the plot. So you have to start putting them into situations, but be there as a coach to help them figure out how to make decisions and gradually increase responsibility. Don't give them a big project as their first project that they're going to fail. Give them a small project that they can succeed at. Build their confidence, just like if you're training a kid in athletics. You don't put him out with the NBA team the first time he tries to shoot a basket, right? You give him training, you get him a coach, and then as he gets better, he competes, and then eventually he gets to a good position in a sport. It's the same thing when you're in a business. And there are people like myself who will help the family put that training into place. It could be a combination of they need book training, they need MBA school. I mean, a lot of these kids nowadays are trying to tell their dads. I just had a conversation with somebody. I don't need to go to college, Dad. College is overrated. I'll just read some books of my own and then I'll take over your company. Well, good luck with that. That usually ends in tears. Make them go to school. Make them go to school. Why? Because they have to show up in class every day and they have to be graded by somebody else. They have to have a taste of the real world. They have to handle themselves, ideally a school where they're not living at home. And make them graduate at least from a BA before you give them a job. It's really important because otherwise there are a bunch of kids sitting in the Hamptons in big houses, smoking weed, working for their dad. And that dad is miserable, the mom is miserable, and those kids are also miserable, because they've lost the opportunity to really develop themselves the way they need to.
Well, I think you're going into back to the governing doc of the Constitution and the band it puts together, because this is a very serious issue that we're discussing. Is the core family values, is how does the family view education, how does the family view discipline, and all of that kind of stuff. So I think that have you incorporated this whole sort of selling off the business onto your 350 question?
No, I haven't, but that's a great idea. I mean, it could be in there. Generally, it's an early discussion, however, because again, if you're going to sell, is that in line with your family business because we want to change everything? Or, we had some people, unfortunately, they only had one child and that child has special needs that he can never or she can never take over the business. They're going to be in a home their whole life or with private caregivers. So then what do we do with the business? Sometimes the kids just didn't make the grade. Sometimes the parents didn't prep them, or sometimes there's a medical tragedy and they can't take over. So every family situation is very unique. However, I will tell you that you can start from your very first allowance training your children. Now, there's a wonderful document that I reference in my book, The 7 Pearls of Financial Wisdom. It was published in the Smithsonian Magazine, and it's the Rockefeller Allowance Contract. So when John D. Rockefeller was the wealthiest man in the United States, he made an allowance contract with his son, John D. II. And he gave his son, now this was the wealthiest man in the United States, $1.50 a week for an allowance, which was a normal allowance in any normal kid, not the kid of the wealthiest guy in the country. He could spend 60%, but he had to get 20% to charity and about 20% to savings. If he did it correctly, his dad would review all his spending and all his activities every single week. His dad took time out of his very busy schedule to personally review the math that the son was forced to write everything down. But where did the money go? If he did it correctly, he got a raise of 10 cents. If he did it incorrectly, he got dinged 10 cents a week. If he had voluntarily put more into savings or charity, his father match funded that amount. Now, any parent can do that with their children. You don't have to be a Rockefeller. But what did that do? That caused those kids, that boy, to have his brain wired in a certain way, which is I don't spend all my money. I know where every penny went. My dad knows where every penny went, or my parent, and I'm saving and I'm giving to help others. I can tell you that family still has those principles well embedded in that family. And when you work with a young person in that family, they're very mindful of their spending. They're very charitably oriented, and they always save money. Because that's a family value that you embed by certain activities that start from the very first time you lose a tooth and you get a quarter from the tooth fairy. You make 3 piggy banks: savings, spending, and charity. And you put that quarter and divide it into 3 piggy banks. And now you start to wire a kid's brain in a fun and painless way, so that the time he or she is old enough, they understand it would never occur to them not to know what they're spending. Contrast that with a lot of kids today.
Well, when you're working in an office building in New York, you'll see these young kids. They've got a Starbucks in the morning, a Sweet Green at lunch, and they got a DoorDash late in the afternoon, and now you're spending $60 a day. Yeah, and that's not even including clothing or anything else. So There's also the Rockefeller Bank out there as well. But that's a whole nother story. So we've made a couple of comments here about the Gen Zs or youth and sort of the stereotypes that they are. But I'm sure that a lot of them are not, fitting that mold. What are you hearing from the younger members of the generation vis-a-vis their relationship with the Constitution that the family has put in place? And if they have any questions or comments or suggestions for that document, how was that well received?
Oh, that's a great question. Well, in fact, a lot of times I do a lot of speaking at conferences, and it's often the young people that approach me, and they're having trouble with their parents. So they have ideas. They've perhaps been to business school, and their dads are old school patriarchs who want to be a command and control kind of guy and don't want to hear anything about changes, don't want to have a constitution, don't want to have rules. He just wants to be the rule of the family. So we have situations like that as well, where it's the kids coming into the family, bringing this idea of a rules-based governance process into the family. And when I do a constitution or work with a family, I always encourage the parents, at least if your kids are college age and up, let's have them fill out the family values. Let's have them be part of the family values exercise, creating those rules and creating what do those words, what is the phrase that describes honesty or fair-mindedness or international values or whatever the value might be. So I like to bring them into the actual creation of the values. And then depending on how much the parents are comfortable with telling these young people about the family wealth, there are lots of parts of the Constitution. For example, prenups. For example, when do you get to work in the family business? How do we handle disputes and resolve them? All of those areas, young people have very different ideas than we do. And interestingly, young people are much more comfortable working in teams than older people, because all the times that they've been in school has been very different than when I was a schooler. So one person had to figure things out. Now you work as a group on almost all projects when you're at school as a young Gen Z type of a person. My daughter does that all the time. So they're much more open to this idea of collaborative, rules-based, gamification almost of the family office, because that's how they live their lives. And they got great suggestions. So I agree, we have to involve them. And what I always say is once a year, as part of the family meeting, there should be at least an hour so to say, okay, is this Constitution working? Do we like it? Does it suck? Should we change it? What things do we have to tweak? Generally, you keep the values because those are heartfelt and usually people agree with them, or we don't choose them until everybody's really in agreement. But then, what rules do we need? What if suddenly, I have a situation right now where the person said to me, 2 of the siblings hate the sister's boyfriend, and they're very worried that she's going to marry this guy. And the dad is worried too, but she's very stubborn and is planning to marry this person no matter what. What do we do? Have we made enough rules in the Constitution? Are we really going to kick her out of the family if she marries this guy? What are we supposed to do? So that's an example where some problem will come up where you have the Constitution to reference, but you also might discover you need to change that Constitution because we're now facing a situation that we never thought we would face before, which is how do we, where do we draw the line with what we'll tolerate in terms of somebody coming into the family? It's very challenging.
Especially when humanity rears its head in like that very given situation.
Yeah.
To go back to more of what your firm does and what you're exposed to, you're involved across the globe, and there's a lot of shifting geopolitics. We've got tensions abroad. There's a number of worlds. Where's Pepper International? Or how should family offices adapt their investment processes to hedge against some of these uncertainties? I mean, there's trade wars, tariffs, all this kind of stuff. What role do alternative assets or diversification strategies play in building true resilience in a globalized economy?
That's a great question, and one that I think we're facing more and more nowadays, because whatever we're doing here in the United States is now affecting our, politics are affecting the rest of the planet, which then affects global markets. It affects our customers if we own businesses. It affects our employees. The interconnectedness of everything is only getting more extreme, and AI makes it split-second interconnectedness nowadays. So decision-making times have been incredibly compressed. The first thing I go back to is process is your friend. So by having that very strong investment process and putting that in place when there is no major crisis going on, we're not in the middle of a pandemic or a major market meltdown, which frankly we might be due for pretty soon once again, then it's the better time to make that process and make some hard and fast rules. So for an example of that, a simple one that is the first risk mitigation that everybody should do, 3 years worth of personal and business expenses in the bank in a cash equivalent, okay? This is not the time to be over leveraged and have every dime in illiquid investments or redeveloping real estate or private equity or whatever it might be. You need to have enough liquidity to make it through 3 years. Why do I say 3 years? Because we saw what happened with the pandemic. It's a lot longer drawdown than we all expected it to be. Even 5 years is better if you have enough liquidity to do that. Then you're going to sleep much better at night and be able to make less pressing and fearful decisions when things go haywire, which most likely they will. We've got massive bubbles building up in AI and technology. Even though I'm a huge tech bull on the investment side, when I act as an independent CIO, you have to watch your position sizing. If it starts to get way out of whack with what your asset allocation is supposed to be, you have to bite the bullet and sell down a little bit, because putting all your eggs in one basket has never worked for any human anywhere at any time, whether there was a public or a private market. So the first thing is becoming more liquid, having enough liquidity to weather a storm. The second thing that I see family offices doing, quite frankly now, is opening accounts offshore. Now, you never thought you would hear of Americans going offshore, but I cannot tell you how many people now are putting money in Switzerland, for example, or Dubai or Singapore, gold or cash, in banks outside of the United States, because they're very worried about what's going on in this country. And they don't want all of their money. If suddenly we have a true authoritarian government going on here, and there are capital controls, which are the very first thing that an authoritarian government tends to put into place, capital controls, they want to have access to some cash outside of the United States. I never, in all the years I've been working, which this year is 40 years, I never had people talk to me about worrying about being able to get their money out of the US until this year. So I'm seeing diversification geographically for Americans. I always saw that for people from other countries, but never for Americans. But now the Americans are doing it as well. People are also opening up branches of their family office in Switzerland, in Dubai, in Singapore, and other places. Uruguay is another interesting place that people are starting to put money in. Why? For the same reasons. Let me just have some pockets of wealth outside of the United States. If things go haywire in the United States, I can jump on my plane or get on a boat and get out of this country and be able to live until things calm down over here.
Well, I think reserve currency and de-dollarization is probably the driving force of that.
Absolutely. And I don't think Bitcoin is the answer to that.
No.
Because Bitcoin, you've seen, absolutely tracks risk. So when people are happy, Bitcoin is going up. When people are terrified, Bitcoin is taking. Okay, so Bitcoin is not where you're supposed to hide with the dollar. It's not going to work, people. Yeah. That is the worst possible strategy you could take.
Yeah, I remember the original Bitcoin was supposed to be non-correlated, and now that is
it's 120 million % correlated. Yeah. So that's not where to go for de-risking into Bitcoin. Having said that, having some money in Swiss franc in Switzerland that you can access, I know a lot of people who are doing that. I have friends who work at Pictet. They're one of the banks that has a legal way for I'm not talking about illegal money, mind you. This is legally opening offshore accounts where you check the box on your tax returns, you check your FBAR, you say, yes, I have offshore accounts. It's completely legal. It's only illegal if you don't declare it.
Right. To move also in terms of some of the things that you work on, you're very active with what and you were recognized as one of the 50 most influential women in private wealth. And you also wrote the 7 Pearls of Financial Wisdom. You've empowered women, you've empowered all these women controlling over half U.S. wealth, which is probably going to grow because women tend to outinvest men. How has the rise of female-led family offices influenced investment processes? And what advice do you have for emerging women leaders and their vision in traditionally male-dominated spheres?
Well, it was very interesting. When I wrote the book, The 7 Pearls of Financial Wisdom, A Woman's Guide to Enjoying Wealth and Power, which you can get on Amazon, and I co-authored it with Camilla Webster. He's a wonderful journalist who's now a full-time artist. We interviewed over 60 female financial experts, and we started looking at numbers, and this was back in 2012 when the book came out. And it was unbelievable because we had just gone through the great financial crash of 2008, 2009. Well, HFRI, the hedge fund index creator, came out with some very interesting numbers that the female hedge fund managers had half the drawdowns and double the return of the male hedge fund managers during the crisis. Why was that? People wondered. Like what? Same thing. Mutual funds run by women highly outperformed during that last big crash. The question became why? Well, when you look at a lot of the statistics out there, and women, by the way, think they're terrible at managing money and, have been sort of brainwashed into thinking they're just not very good at it. But the numbers absolutely say otherwise. One of the most interesting studies I found was that when men take investment risk, men have a surge of testosterone. That makes them feel good. They're rewarded inside when they have a testosterone surge, just like when your team is winning. And they are rewarded by feeling good when they take risk. When women take investment risk, nothing happens hormonally. They don't have any kind of surge of any particular hormone if they take an investment risk. So they tend to be more risk averse. They tend to be longer term thinking, and they tend to think about this particular portfolio in the context of the overall family situation, for example, where the guy is looking at the portfolio and maybe he's comparing it to other similar hedge funds, but he doesn't go much beyond that. So men tend to see in a forest, for example, men see the tree, the women see the forest. So men see the object, women see the environment. And that leads to different types of investing. And for women, they tend to like longer term, more liquid, less risky, less volatile investments. It's the grasshopper and, the ant or whatever it is. It's that long-term, steady growing things versus the big score, right? Both are good. You can make money both ways. But the impact of this in terms of family office, very interesting, because for family offices, you're trying to not lose money and make a lot of money by compounding it over multiple generations. You're being paid to not take risks. You're being paid to be a little bit more boring. Oftentimes, families took the big risk or the big score on one thing, and that's how they made their fortune. But once they have that fortune, it's like we're supposed to keep it and grow it. So it's a very different personality. And so therefore, women, when they come into these family office investment committees, or they look at investments that the family might make, they bring a very different perspective than the guys. And so I think it's a good balance. I think women should feel very comfortable that they just see investments in a different way. It doesn't mean it's better or worse. It's just different. And that, it's sort of the two hands, left hand and right hand. When you put them together, you have a good total picture. But I think women's perspective coming into a family office investment environment is extremely valuable because it's more long-term, it's more risk-averse, and it's more holistic. And those are good characteristics to have on your investment committee or to be working in your family office.
And it's always, return on principal or return of principal.
Correct. And it's also over what time horizon, right? What time horizon are you looking at? Yes, quarterly earnings tend to drive you toward making short-term decisions. But if you're trying to invest for multiple generations, I have families who make some portion of their portfolios their 100-year investment bucket. And that's the most exciting bucket to them. What could we do now that will be having value 100 years from now? And that one family was amazing. They decided, because they loved Hawaii, to bring back agriculture to the island of Hawaii, because Hawaii was importing all of their groceries and their lettuce and vegetables from the mainland, which was ridiculous because they had been basically turned into a pineapple plantation and had never gone back to actually having food sustainability. So this family took that on. They started training farmers. They started buying up these old plantations and creating new types of arable land. That's a long-term vision that they will really only see it 100 years. But that's the kind of thing that having a family office allows you to do. You can create these legacy projects. Or even, I think it was the Gates Foundation that decided to go after and eliminate river blindness, as an example. And they put into place all of these programs that have taken many, many years. But suddenly in certain countries now, there's no more river blindness because of the programs they put into place. And they made tremendous progress on malaria by trying all these different types of long-term processes to get rid of malaria mosquitoes. By focusing on those long-term problems, you can make a big impact. And that's something that a lot of families really find satisfied for some portion of their wealth.
Yeah, mission-driven investing is definitely wrong for sure. So we've been talking about your client base, which is, I would gather to say, smaller family offices, maybe some that have under 100 million. They can't afford a lot of these. Their processes and procedures that you're putting in place. Through your external CIO services and virtual models, how can these families establish outsourced investments processes that rival their larger peers? Perhaps starting with lean investment committees or targeted advisor networks or doing other things that you may suggest.
Yeah, well, I think it doesn't matter what size wealth you have, whether you have $10 million, you have $5 billion, you have to have a process that works for you. And again, outsourcing is your friend, because compared to when I started 24 years ago, there are outsourced solutions that were incredibly cost effective and incredibly secure. An example being Sumitas. That's another system that I love. Again, started by a friend that I worked with at Rockefeller before, Bill Wyman, backed by a family. You can put all your legal documents in signed DocuSign and keep everything in a super secure environment, free from hacks. Basically, they've never been hacked, not would. But it's a very reasonable, cost-efficient system, rather than you trying to cobble together technology systems to protect your valuable information. Out of par, we talked about, it's not that expensive relative to the kind of gains you can get. You can be as sophisticated as a big shop by just using a lot of the built-in technology inside of Adapar. A third one, for example, would be Plum Bookkeeping. I love them. They're a new entrant into the market, but you can outsource all that bookkeeping to a very secure system and a lot of controls and cybersecurity, rather than having this little person in your office doing bookkeeping that we don't know what they're actually doing all day long. So it's a much better way to keep control over things. Certainly concierge, air travel, security services, all these things now have specialized outsourced consultants. And when I recommend a consultant, I'm only paid by the family. And you should ask that when someone recommends a consultant to you. Ask them, are they receiving a little kickback from that consultant or not? Because I like to make recommendations because I really think these outsourced providers are good versus, oh, this one's paying me and that one's not paying me. So, but you can be quite cost effective nowadays by using a lot of outsourced solutions.
Well, and I think the world is cooperating here between all of the technology. Before we get to the lightning round, one last question. What's the single best indicator of success for families that you've witnessed over the last 25 years?
You know, it's one thing that stands out head and shoulders above everything else. And when I meet a family, I can tell actually probably in the first meeting whether or not they're going to make it as a good family office, and even whether they're going to have money 3 generations from now. And I would say the families that are demonstrating love among themselves, love of their family members, and place a high value on ethical behavior. Love and ethical behavior are the 2 characteristics of the families that make it. Love, because they actually care enough to follow through, and they care about these generations that haven't even been born yet. So they have this attitude of stewardship. And ethical behavior, because in the end, good guys really do win. The bullies, the short-termers, the people that like to cheat everybody, they win in the short term. But I've been around Wall Street for 40 years. Most of those guys who behaved that way in the 80s got indicted at some point and got arrested or went to jail or ended up with nobody wanting to have dinner with them anymore. So being ethical, being caring, and loving your family, well, if you have those characteristics, come and see me because I want to work with you. You're the family that's going to make it.
That's a fantastic answer. So what we bring here is a lightning round. So what's the one metric every family office should track daily for investment health?
What's the one metric daily that they should track?
Yep.
Gosh, well, how much cash they have.
Perfect. Good answer. Best book recommendation for small family office leavers.
Anything written by Jay Hughes. The man is a wonderful writer. He's a long-term attorney for families, and I recommend all of his books.
That's great. The biggest threat to family wealth today.
I would say inflation and reproduction, because the more family members you have, the more money you have to take care of them.
Your favorite alternative asset class for risk-averse small family offices.
Gold.
Perfect.
Buy that gold and stick it in a vault. You'll be glad you did.
We're all fans of gold. How often should a family review its investment committee chart?
Every year. Once a year. Again, when you have your annual meeting, review your charter.
True or false? Virtual family offices are as effective as in-house for decisions under 50 million AUM.
Absolutely true.
I agree. Top tip for integrating family values into portfolio allocation.
Do your constitution, do your values, and then insist that that is part of the investment policy statement.
AI and wealth management, game changer or gimmick?
A little bit of both. I think in some ways that would be a game changer, but a lot of it is a gimmick. And don't just do what AI tells you to do. Use your own human brain.
Fair enough. Legacy building must-have, philanthropy or education?
Education. You must make those kids go to school. Do not let them get out of going to school.
And do you believe there's an underestimated risk in tech-heavy portfolios?
A lot of tech-heavy portfolios now, position sizes are too big relative to the overall asset allocation. So just bite the bullet and trim. It won't hurt you. In the long run, you'll earn it twice over.
Well, Carol, thank you so much. This has been wonderful.
Thank you, Chris.
Take care.